Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. How are you all doing? Taking a look at WBD, their earnings came out today. Stock is up almost 12% this morning on the back of those earnings. Remember though, stock is still down about 20% year to date. This has done the $7 to $9 dance quite a few times. I have been a buyer of these shares in the $7 range. Whenever it hits that, I actually bought some leaps when it was in the low sevens just a month or so ago. Feel like that's a good value risk reward proposition. The thesis remains the same. Yes, the legacy media business is shrinking. It's a melting ice cube. People are cutting the cord, but they do have a direct to consumer business that is growing at a decent clip. The thesis would be that one, the valuation here is enticing for what it is today. It's generating $5 billion in free cash flow, has a market cap in the low 20 billion range, an enterprise value in the low $60 billion range. That's not too bad in relation to where the market is. And you've got this upside of this direct to consumer business offsetting the losses of the legacy business that's shrinking. The downside would be direct to consumer business sucks. The CEO sucks. He keeps canceling stuff. People hate the service. Like legacy media business keeps shrinking, blah, blah, blah. All of that stuff goes poorly. You can't win them all. Sometimes you make a bet and it doesn't work out. As always, guys, this is not financial advice. Please do your own due diligence before you make any investment decisions. For me, the risk reward is pretty interesting. The way I look at it, you've got a competitor like Netflix trading in that $350 billion range. Is that where it is right now? Yeah, $340 billion range. And now I'm not saying WBD is anywhere close to Netflix. Netflix has won the streaming wars. It's over. Call it. The guy is dead. Netflix has won. But WBD, even if it becomes a third or a fourth of the business that Netflix has on the streaming side, could still be a real good return from that $7 to $9 range if that business can grow well. And these earnings show that it's actually growing at a decent clip. You can kind of see, yeah, revenue is not great, down about 4% on an as-is basis. EBITDA down about 19%. Free cash flow down quite a bit. Again, this is comparing against a strike quarter in the last year, so keep that in mind. They're continuing to pay down debt, pay down close to $1 billion of debt during Q3, and then Q4 is their highest free cash flow generating quarter, so there'll be more debt to pay down of about $40 billion in gross debt. And again, the debt's not too bad, 4.7% rate overall, and you can kind of see the debt schedule here and where it matures. Good portion of it is like 20 to 30 years out, so keep that in mind as an investor. If you're worried about the $40 billion in debt, certainly a concern if their free cash flow dries up, if this business tanks. But right now they're doing a pretty good job of paying that down. This was, a 50, 60 billion dollar debt entity just a couple of years ago, down to about 40 billion down. 40 billion now, net leverage in the low 4x range, going to get to the 2.5 to 3x range in the next couple of years. Content continues to be solid. The Penguin's doing pretty well. The Joker 2 was terrible though, so when you look at their studio segment, keep that in mind. It's going to be up and down. They'll have hits like Barbie. They'll have hits in their gaming division like the Hogwarts Legacy game, and then they'll have turds like Joker 2 and poor games that come out like Mortal Kombat 1, which didn't do that well. So the gaming division struggling a bit. The studios division, maybe up and down. Who knows how Superman will do, but Beetlejuice was pretty good. Then you've got this legacy segment, legacy network segment, again, shrinking, actually up on a quarter over quarter basis because of their content gain over here, but in general, distribution down about 8%, advertising down about 13%. And this is where they make the majority of their money, 2.1 billion in adjusted EBITDA, majority of their free cash flows coming in from here. And this is where investors are rightfully worried. This is shrinking. What's going to come in and save the day for a company like this one? Or is it going to simply shrink? They're losing some content on the NBA side. They lost that deal. But the nice thing is when they signed their deal with Charter, they actually didn't lose a lot in carriage fees. In fact, the carriage fees for TNT remained the same. What they've been doing now is kind of bundling their streaming product into that, just like how Disney did. And that's sort of going to be the new norm. Hey, give us a similar deal for our networks, which aren't all that exciting anymore because people are canceling the cord. But in order for you to make your product more attractive, your cable product more attractive, here's our ad-supported streaming services that you can get. And as WBD will add more subscribers to that, they'll retain those affiliate fees, those distribution fees, and those people will watch ads. And if you think about Max, there's plenty of room on the advertising side. None of their HBO content has advertising in it at all. Some pre-roll stuff maybe. They're going to amp that up, and I think advertising is going to be a big growth opportunity for them on the direct-to-consumer side. Not great for consumers, but it is what it is. That's just kind of how businesses roll. I actually have the ad-free service. On top of that, in the next year or two, they're going to crack down on password sharing. People don't like that, but it obviously worked for Netflix, so that's going to be a growth driver for them. And speaking of growth, I mean, they grew quite a bit. This was a surprise for me, a pleasant surprise. 7.2 million global additions between Q2 and Q3, up to 110 million total subscribers, 52 million domestically, 57 million internationally. They are very much expanding internationally. They're only in 55% of the markets they're going to be in before all is said and done. Plenty of growth ahead. When you kind of look at Netflix as a comparison again, domestically, Netflix has 85 to 90 million domestic subscribers with an ARPU of about $17 to $18. HBO Max or WBD is at $12 with 52 million subscribers. So again, not saying they're going to get anywhere close to where Netflix is, but you can kind of see the runway that's there internationally because there's so many markets that they're not in right now. They only have 57 million subs versus almost 200 million for Netflix, an ARPU of about $4 for WBD versus about $8 for Netflix. So again, plenty of runway internationally, decent amount of runway domestically. That's what interests me about this investment. You kind of look at this business right now, already moving into positivity on the EBITDA side. And that's kind of misleading because that does include the HBO channel itself, the one that's, on linear TV. It's not just Max and Discovery Plus. So maybe some of that is really driving the profitability here. But end of day, plenty of upside on the advertising side from their ad-supported model as they add more subscribers to that for people looking for a cheaper alternative, or for people who are into the bundled offering with Disney Plus and Hulu, or for people who are into the offering from the cable subscription that they may get for free through their cable subscription that they pay for. So, and on top of that, you've got the expansion into other countries in Europe, into Asia, into Australia, into various other markets, and a lot of that will happen through 24, through 25, through 26. So at least internationally, you're going to see pretty decent growth for the next couple of years. That's going to ramp up revenue, probably going to ramp up EBITDA a little bit. You have to remember, though, as they move into new markets, that does entail an initial setup cost, initial marketing, initial content spend, etc. So some of their mature markets are probably profitable already. When you look at the United States, probably profitable. When you look at some of the markets they entered in 2024, they're going to enter 2025 losing money. As those markets mature, though, this is going to become a profitable business over time. And that's where the switch flips. That's where suddenly this becomes an interesting business. And the same thing happened for Netflix. For a long, long time, they were growing, but they weren't making money. But then suddenly the switch flipped. They hit a certain subscriber mark, and suddenly the stock was off to the races. The stock was generating a ton of free cash flow off of their direct-to-consumer business. And I think that WBD can get there as well. Max isn't quite as good as Netflix. They don't have the breadth of content, but the content is still pretty good. The sports content is pretty decent. Even if they lose the NBA, they've signed other deals with other sports entities that are going to be there. And they are moving into these new countries. They're going to grow that subscriber number. They're guiding towards decent growth for Q4 2024 already, as they talked about during the call. They talked about decent growth for 2025. They already initially, a couple of months ago, said that, hey, by the end of 2025, we feel like we can have this be a $1 billion EBITDA business. And on this call today, they basically said, yeah, we think we're going to exceed that because we're seeing good signs from the growth in some of these markets that we're expanding into. One of the things that worries me, though, is like, how can they move the growth ladder up a little bit domestically? Again, some of these bundles are going to be a solid addition to that, but it's still basically flat year over year, which is not good to see. A lot of their growth is coming from international markets. And again, the ARPU there is less than half of what you get domestically. So it's really important to start getting domestic growth up because that's where the majority of your money is made. So it'd be nice to see in the coming quarters if they can get that going. So overall, good earnings. Again, some of the numbers, top line, might not look amazing. They did actually hit positive net income, which is good to see. free cash flow. Their next coming quarter is their biggest free cash flow quarter of the year. So they're going to keep paying down debt. The question and the story here is going to continue to be direct to consumer. Like, the reason the stock is up today is not because the earnings are good, not because revenue is good, not because the free cash flow is good. It's because they're adding more subscribers than the market projected. And if they can keep doing that, this stock can keep running in the next couple of quarters, in the next year or two. But really, from a long-term perspective, when you look at this, when I look at this as an investor, it's like, well, I know their free cash flow in 2029 from their network segment is going to be, 60 to 70% of what it is today. Can they increase their direct to consumer free cash flow to offset that? And if the answer is yes, to me, that should be a really good investment. The answer is no, it gets a bit iffy. And if the answer is direct to consumer is offsetting that and more, this could be really interesting. And that's why I'm an investor in WBD, because I feel like the upside is substantial, and the downside is there. But right now, I'm not seeing it maybe as clearly as the market is seeing, because the DTC segment is growing at a pretty good clip, and I like that. So am I a buyer today? No, because I already have a decent sized position. If this stock kind of does the same thing it's been doing in the last 6 months and drops into the $7 range again, will I buy more? Probably. Also note that I own some leaps as well on this company, so I have some exposure via options. If this stock runs up into the 10 to 12 to $13 range, maybe I'll take a few shares off the table because I have those leaps. That's a pretty sizable exposure that I have there via leaps and shares. So that's my take on it. Let me know what you think down below. As always, guys, this is not financial advice. Please do your own due diligence before making any investment decisions. Let me know down below what you think about WBD. Are you in agreement with what I'm saying? Do you disagree about anything? Are you a huge fan of David Zaslav, or do you hate him? Comment down below, like, subscribe, all of that good stuff. And let me know if you want me to review any other companies. Thanks for watching. Bye.